Okay, this is the quiz from today. Let's see how we can get through, how many questions we can get through in a short amount of time. If we have to, we'll break this up into 2 bits or so. First question, I think everybody should have gotten this right. The business assets of a sole prop are owned by an individual. End of discussion. Answer is D. Question 2, identify which of the following statements is true, and that is, are C and S corporations synonymous? No. Newly formed corporation is by default a C. That is true. Corporation can pay its owner a salary for whatever it wants. No, it cannot pay a salary for whatever it wants. It's limited to reasonableness under the code that we discussed in class. So the answer is B, that a newly formed, and we said this a number of times, that is by default a C corporation when it's first formed. You can elect it to be something else, but we covered that quite a bit in class. Number 3, identify which of the following statements are true. If a C corporation distributes its income to its shareholders annually, it avoids the double taxation. B, capital losses incurred by a C can be used to offset the corporation's ordinary income. That is not true. That we know is not true. C corporation operating losses are deductible. That's not true. And the question is whether A is true. It's certainly partially true in a sense that if a corporation distributes its income in the form of a salary that is deductible, then you can avoid the double taxation, provide the salary is reasonable. But distributions are not deductible. That's another word for distributions is dividend. So the answer is D. All of the above are false. Number 4, identify which of the following statements is true. The repeal of 351 would result in more existing businesses being incorporated. Not true per se, because 351 is B. It was enacted to allow taxpayers to incorporate without incurring adverse tax consequences. And so B is the true and only answer here. The exchange of stock for services is a taxable transaction, so that doesn't work. Number 5, Carolyn transfers property with an adjusted basis of $50,000 and a fair market value of $60,000 in a 351. What's her basis in the stock? Well, this most of us should have gotten. It's a carryover basis. Her stock is going to have the basis of $50,000. End of question 5. Question 6. Which of the following statements is true? When depreciable property is transferred to a corporation in a Section 351 exchange in which no gain is recognized, the corporation must continue to use the transfer's depreciation method and recovery method. We didn't cover this as such in class, but we did, although we did talk about the anti-churning rules when it comes to depreciation. This was covered more by the chapter itself, and answer A is true. And since that's a true answer, and this one's all of the above are false, that can't be true. So the answer is A for number 6. Let's see if we've got number 7 on here. Yeah, we've got number 7. Trail Corporation has gross profits of $140, deductible expenses of $180, has a net capital gain of $60. So Trail's got 40 here, 180 here. That's a $40,000 loss, and $20,000 of capital gain income, which is taxable at regular corporate rates in a C corporation, and that means that it's a $60,000 capital gain. So that means that the net between the two becomes $20,000 taxable income. There's no special capital gains rates for a C corporation. Question 8. If a corporation's charitable contributions exceed the deduction limitation in a particular year, the excess becomes a carryover to a maximum of 5. Yes, that's true. So that A is looking good. May be carried back. No, there's no carryback. May is not deductible in any future year. No, there is a carry forward, so it's carried over and definitely not true, so A is the only answer there. Number 9, Island Corporation has the following income and expense items for the year. Gross receipts, $60. Dividends received from a 15% owned domestic corporation. Expenses connected with sales. So the income is $60. The expenses is $30. That's a $30 net. What about the dividends received? This is subject to the dividends received deduction based on the ownership. It's a 70%. 70% of $40,000 is $28. 28 is not includable income. That's the dividend received deduction. It means it's not includable in income. Leaves 40 minus, let me do it this way. So 40 was the dividends received. 28 is not subject to tax. 12 is. 12 added to the 30 brings the total of taxable income to 42. Answer A. Number 10. Which of the following is not subject to a classification as a personal service corporation? Law we know, accounting we know. We didn't mention this in class per se, but the textbook would have explained performing arts. Construction is definitely not personal service. And even if the textbook didn't mention this, and even if you weren't using your textbook, the fact that performing arts is a service related, you should have been able to figure out that construction is the odd man out here with number 10. Number 11, a corporation distributes land and the related liability in a non-liquidating distribution to a shareholder. The land is a capital asset. Okay, that's good to know. Has adjusted basis of 70, fair market value of 100, subject to a mortgage of 120. The corporation must recognize what? So we've learned in the concept of a non-liquidating distribution that the corporation has a deemed sale. So what's the sale price? Well, we usually look at the fair market value, but here it's subject to a mortgage of 120. So what's the real sale price? Picking up the mortgage is the real sales price, which is the concept of the fact that we are relieving the corporation of debt. That's like cash to the corporation. We learned that principle in class. And since that's higher than the fair market value, so we're looking at a higher number for the sale, 120, basis 70, gain 50. And that's the answer A. And it's a capital gain, that's true. Because it's a in the hands of the corporation, we were told it's a capital asset, so it's a capital gain. Made the problem easy to identify because we were told it's a capital asset. Number 12. Which of the following transactions does not have the potential of creating constructive dividend? The other word we learned for that is deemed dividend, but we learned both words. And it's based on reclassification by the IRS as not being a dividend. It's reclassified by the IRS as being a dividend because it's not deductible. It's something that the company deducted, but the IRS says, no, it's not a deduction. So let's see what we got. We got compensation paid by a corporation to a shareholder. Well, that's certainly subject to being reclassified as unreasonable comp, and the unreasonable comp portion is a deemed or constructive dividend. Shareholders' rental property of corporate property at less than fair market value. That sounds like some type of favoritism that the IRS would say is the getting a value to the shareholder who's getting value at less than fair market value. So that's some kind of deemed or constructive dividend to the shareholder, potentially, if the IRS makes a case of it. C, the corporation buys the owner a fancy car. Well, that certainly sounds like some shenanigans going on there where corporations deducting this fancy car, and it's really a benefit, a personal benefit. That's the whole key of B, personal benefit, and the key of A is salary that's unreasonable. That's a personal benefit to the individual. And so C would not be deductible, or at least the IRS could make the case it's not deductible and reclassify it. So all of the above can result in a constructive dividend. Let's do one more. 13, an individual shareholder owns 3,000 shares of stock of a company with a basis of $10. Receives a non-taxable 5% stock dividend. The basis share per share of the common stock after the dividend. What is it? So this is a case of doing the following. It was 3,000 shares. The stock dividend is a 5% stock dividend. That means 5% more stock. So if you multiply times 1.05, you'll get 3,150 will be the number of shares held by the shareholder after the stock dividends. Stock dividends, we learned, are not taxable, and the basis remains the same. They didn't receive anything. Their overall basis remains the same, which was $30,000 in total. How did I get that? That problem gives you $10 per share, 3,000 shares, $30,000. Now, this same 30,000 over what was 3,000 shares is now over 3,150 shares. So what's the basis per each stock now is $9.52 per share. End of argument. And the answer there is C. We'll stop here and continue with number 14.